Hey everyone, thanks for joining us. We are the Hatch Homes Group and it's our weekly market update. And today we're going to talk about what if the market did crash. Before we get into the details, if you're liking what you are seeing every week, then please remember to like and subscribe to this. So anyhow, we have a lot of clients that are, this common fear of, okay, well, what if the market crashes? And I know we've talked about the bubble in the past. We don't think the market's going to crash, but we thought it could be really helpful to just look at that. Like, what if it did? What if it did? So first thing, we actually, we have a history, obviously, of we had a market crash. We had a great recession caused by the housing market. So let's just look at that. We got those numbers. So we can look at that worst case scenario that we don't think is going to happen again, but let's just look at it to make you feel better.
Yeah.
Okay, there it is. So that's what home prices look like. We saw a peak in 2007 and 8, and then a crash, definite crash. And the bottom of the market was around 2011, 2012, and then up to where we are now. And there's more talk of recession and people thinking, oh, that means crash. But I'd like to emphasize what Angela just said. We are not predicting a crash. But there could be some adjustment to these rapidly increasing prices. Yes.
But so look at that in terms of the numbers, right? So it looks like people that were able to hold on to their property, right, from 2005 to 2013.
Yeah. This was very painful, and we were in the middle of this when there were short sales where people unfortunately saw their net worth going negative. Horrible situation for some people, but
yeah, they managed to make it up, right? Mm-hmm. Within that, if the people that didn't have much equity, skin in the game, things like that, some financial crisis that happened, were not able to hold, but the people that did were able to hold. Well, we know now that they're well above those prices at this point.
Yeah.
And so the other thing to look at is, okay, so say we don't think we're going to go through that huge crash, but what if, we just go to regular appreciation year over year? I think that people are going to think that regular appreciation feels like a crash, especially from what we have been experiencing lately of double-digit year-over-year appreciation, sellers expecting their home to go over list price. We remember in 2017 where we had double-digit appreciation, and then come fall time, it just didn't go up as much. Homes were sitting on the market. There was sellers were reducing their price, having price reductions, and that was the immediate headspace is a crash. It's a crash,
There's a panic. There's a panic.
Panic.
A slight feeling of change.
Yeah.
It's oh gosh, what's happening?
Yeah. So we think that a regular appreciation is going to feel like a crash to a lot of people, but it is not a crash, people. So, but let's look at that. So say you're buying in this market, house is 550,000, you're going 50,000 over list price, and so you're buying it at 600,000. Okay. So 4% appreciation year over year, more of a regular appreciation. You're going to make that up in 2 years, right? If you go 100,000 over list price, you're going to make that up in 4 years. So that should kind of hopefully give some clarity around this fear of, oh my gosh, I'm going 50, 100,000 over list price and the market's going to crash.
Right. A sense of relief that knowing that you're going to be in your house for longer than 4 years, you're going to be making that back.
Yeah.
A couple of points.
Yes.
Since we had that major problem in 2007, 2008, the whole financing industry has changed.
Yeah.
And it's now more like it is with our neighbors in Canada, where they have not had crashes at all. They've seen consistent appreciation despite fluctuations in the economy.
Yeah,
Yeah,
even
we
when
talked
there's an
about that.
economic recession, there's not a housing crash.
Yes,
Yeah,
exactly.
which
Good point.
exactly is what kind of we're talking about here. And also, I think another, difference is the affordability factor. When you're thinking about what would you do if the market did crash, we're in a position now where you have this equity in your home, and you can see, like, from before the market or the Great Recession, people were spending like 28% or more of their income just on their housing.
Yeah.
And now we've actually gotten down to 21.6%, which is actually pretty refreshing. And, in 07, 08, we had people buying houses with little skin in the game. They had like no down payment, so their monthly payments were really high. And we just don't have that kind of thing now. And, like, you can see that, the percentage of income helps, but also, like, our wages have gone up a little for most people. I think wages have gone up. Our ratios are working out really well for us. And I think that's important to kind of think about when you're looking at, the affordability factor.
Yeah.
You're locked in right now. Like, when you buy your home at this low percentage rate, you're locked into that payment. And if you hold on, you're good.
Michelle, I think it's important to point out on that chart that you just had up, the red line is considered the affordable rate. Historically, that's considered an affordable situation with what you spend on your
And
house.
isn't that interesting that in 2017, where I was talking about how we were double digits and then we balanced out,
Yeah.
how when we got down, and now we're approaching that red line a little bit more. So will we see it balance out once we hit that affordability mark? I
Yeah.
wonder.
Definitely interesting to think about.
And looking at rental affordability too, leading into the Great Recession, rents weren't really rising at the same pace of the housing, like not as fast, right? And then here now, with politics and kind of just the rising house market, they've gone up just as fast. It's
Yeah.
not-
Regulation on rent control, right?
Exactly.
And not very much new construction. It's expensive to build,
Mhm.
So, and, if it's expensive to buy a rental property, it's not like you can offer lower rent.
Yeah, exactly.
So there's
Yeah,
a lot.
we remember crazy situations where people were buying because they had such cheap money, easily accessible, and people were buying up rental properties with hardly any skin in the game.
Yeah.
You can't do that now.
Yeah, that's a red flag to us, right? Like, when you approach us and you say, I want to buy a property to rent out, but I have no down payments. Well,
you can't really do it anymore.
First of all, yeah. And also, like, that would be a risky move. And we would want to talk to you about how to leverage that in a different way, because that's something we look for as far as the red flags, right? Like, if you're not going to be in your home for more than 2 years and you have little skin in the game, there's some risk assessment we have to do with that.
Yeah. So with the red flags, 0% down, going well over list price, and then not planning to live there for very long, like we would just want to talk, because those are harder investments at this moment. But if you're going to improve the property a ton, like if you're going to move in and you're going to remodel the kitchen and you got all these great plans, then, I'm not as scared of that. The issue is like not having much equity in your house if you want to sell it in a short amount of time, because you have fees to sell, like there's stuff you got to do. So, and taxes, capital gains, things like that, so all really important things to consider, and we can help you with that.
As always, reach out to us. Let us know if you have any questions about what we're talking about, and like and subscribe and share and reach out. Have a great day. Have a great week.
All the best.
Thanks for watching.